Good afternoon and welcome this afternoon to Selecting an Option Strategy. There's the bell, which means that the market is closed, but we are not. We're just getting started here. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm filling in for my good friend Connie Hill today. And also out there in the chat is my good friend Barb Armstrong, 20 plus year veteran of the financial markets. Great educator, participant frequently with our live events and a frequent contributor to my show on the Schwab Network, Your First Trade. Now, the Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions, but I'm glad to have Barb out here. She's going to be there answering the chat questions that you might have, and welcome to all of you for being here, whether you're in the live version or in the recorded version. It doesn't matter. We're glad to have you here either way. If you're here in the live version, go ahead and chat those questions in. If you're in the recorded version, leave a question for us in the comment section. We'll get back to that and we'll answer that as quickly as we can. And speaking of answering questions, one of the questions we're going to answer today is how might we use some of the tools in our probability functions on the Thinkorswim platform to make a decision about what strategy to choose, and given similar strategies, which one to decide between. So we'll take a kind of deeper dive into probability in this discussion today, and maybe start to put together some ideas about expectations. So as we do that, a couple of quick reminders, a couple of quick housekeeping items that we need to take care of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It's not any kind of individual advice or an endorsement of a particular security, a pattern, or an investment strategy. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions and transaction costs. Long options, investors may lose 100% of the funds invested. Generally, spread trading must be done on a margin account, although there are some exceptions to that, and that's going to be a great conversation for you to have with one of our financial consultants at one of our branches. Also, we're going to be using a bit of technical analysis today, as well as some probability analysis. Remember that technical analysis, probability analysis, fundamental analysis, none of those are guarantees. All of those are theoretical in nature, and Schwab doesn't recommend the use of technical analysis or really any one particular method of analysis as a sole means of investment research. Now, we're going to be using the Thinkorswim desktop software platform. It is a great learning environment. However, it is not a guarantee of future success out there in the real world. Remember that there is risk involved in investing, including the loss of principal. And as we get into this discussion, we'll talk about any other specific considerations that you need to pay attention to as we go through this discussion. So what I wanted to do, again, here really quickly, as we talk through this. Oh, by the way, if we do happen to talk about stop orders, although I don't know that we will in this discussion, remember that stop orders do not guarantee the execution price, simply the activation price. So we'll talk about that as we get to any of those particular strategies. So I wanted to talk just kind of generally, first of all, about the types of strategies that we might be looking at, right? So we can categorize option strategies in a number of different ways, and these are by no means the only strategies that we have that we can choose from, right? Remember, there are four things that we can do with an option contract. We can buy a call, we can sell a call, we can buy a put, and we can sell a put. Everything else is a combination thereof, whether it's a ratioed combination, whether it's in combination with long or short stock. All of that gets us to this variety of strategies. So the taxonomy here is bullish, bearish, and neutral. And this choice between bullish, bearish, and neutral, I think almost certainly depends on kind of a directional opinion or a directional assessment at the outset of the discussion in terms of choosing an option or selecting an option strategy. What is your directional opinion about the stock's price movement? If you've got no opinion, or your opinion is that the price of the stock isn't going to move, you might choose one of the neutral strategies. If your opinion is that it's going to move bullishly or bearishly, then you've got directionally focused strategies that may benefit from that directional price movement. But direction, because price is king, direction, I think, is the first step towards identifying an option strategy that might be aligned with what's going on. And speaking about what's going on, I'm going to pop over here to the Thinkorswim desktop platform. Remember that this is the paper money version. Even though it looks like a real account, it is not. I assure you, this is a demonstration account. So we're taking a look right now at the S&P 500. The market is just closed. It closed right around 56.06. In fact, if we zoom in on the recent time frame movement, and we talked a little bit about this morning, if you happen to have been in my trading futures webcast early this morning at market open, we talked about the possibility of this market in the S&P 500 kind of bouncing up off of that 50 period simple moving average here in this particular case. But it bounced a little bit, and it gave us kind of this doji pattern. Doji is simply the poetic Japanese name for a candlestick where the opening and closing is exactly the same, or very, very close to being the same. And that's kind of where we were today, where we ended up. We opened today at 56.49. We closed today, or I'm sorry, 56.05. We closed the day at 56.06. So just a little bit of movement here in the market today in the SPX. Take a look at the NASDAQ. We see the same kind of thing, although a little bit more movement, a little bit more of a move to the downside, and then rallying back up. So that candle on the NASDAQ a little bit stronger from a momentum standpoint to the upside, and then on the Russell 2000, also a little bit of a doji candle in this particular case, opening at 1984, closing at 1983. Boy, if I could go back in time from 1984 to 1983, knowing what I know now, oh boy, that would be fun. I'm just saying, it was an interesting time. All right, let's come into this next part of the discussion. Now that we kind of have a directional assessment, which I would argue is probably at this point, from the market's perspective, pretty neutral. And that's not at all unexpected, given the fact that today was the opening day of a two-day Federal Open Market Committee, or FOMC, or Fed meeting, which will conclude tomorrow with a statement and press conference. But it's not at all surprising that we're kind of in this neutral or kind of equilibrium perspective. There's a little bit of a wait and see mode. Now, what we might also look at in terms of maybe the next structure to help us determine a strategy would be where overall volatility is. So if the overall market is neutral and we see that the VIX, the volatility index for the overall market, is relatively neutral as well, although it is rising just slightly. And again, I don't know that that's necessarily specific exogenous event driven. I don't know that there was any specific news that drove the VIX higher today, but I think this may just simply be, again, that anticipatory fear of what could happen in the market tomorrow based on some kind of black swan event from the standpoint of the Federal Reserve doing something unusual, right? Going outside of what that expectation is and seeing the market move significantly one way or the other. So options markets generally were pricing things a little bit higher, just in the general perspective that something might happen, to be prepared, right? Properly warned you be, says I. And so we start to see this implied volatility rising a little bit, the VIX rising a little bit. So we've got two kind of out of our three perspectives here, right? Direction from the market and volatility from the market, both relatively neutral. Although I would argue that the VIX, that volatility level, is still on the generally pretty low side relative to where it has been. Now, it's not down in the 15 handle where that typical average has been over the course of the last 10, 15 years. It is a little more elevated than that. And it is a little more elevated than it has been really for the majority of this year. But at the same time, it is below its 30-period average. So volatility on average over the course of the last 30 days is relatively low. That would, in and of itself, benefit strategies that have a long perspective, right? Meaning buying an option, because long options benefit, whether it's a long call or a long put, benefit from low and potentially rising implied volatility. And if there's an exogenous event, if the Fed does something unique, if they come out with a black swan tomorrow, implied volatility is almost certainly going to rise. And so that would be beneficial for a long option. The problem is with a long option or a long option strategy is that oftentimes long option strategies tend to be, because they are primarily directionally sensitive, they tend to be low probability trades. So since implied volatility overall is relatively elevated, but it's not hugely elevated, maybe we have to kind of temper our expectation here for a directional trade if our directional sentiment is kind of neutral, because we go back to that kind of grid of what the markets are doing. And I'm going to come back to this grid right here. This is my index grid, and I can kind of see that neutral movement happening here. We're kind of in terms of technical analysis in between those two moving averages, the 50 and the 200. So kind of stuck in this range. Both of those have acted and could potentially keep acting as levels of support and resistance. We could argue that we've got a support level down here at around the 55.22, and we've got a resistance area up here around the 57.72. And those areas are perhaps bounding this movement in the near term, kind of acting as navigational beacons or buoys, if you will, keeping this market kind of going sideways. Now, that's the market as a whole. What about individual stocks? So how do we choose a strategy? Well, now we kind of have an idea what the market might do. The one other perspective that we might think about here is duration, like the time frame that we might be looking at. So we know that we've got data points coming up. We've got the FOMC meeting tomorrow. That could push the market outside of this range, right? That could be the bump that nudges the market one way or the other, either up out of that 200 period moving average or down below, or it could not, right? I mean, that's the scenario, right? It could stay kind of stuck in this rut, stuck in the middle here with you at in between those two moving averages. So the probability is that the Federal Reserve, and if we look at a variety of different things, we talked a little bit about it this morning in the futures trading class, the probability is that the Fed does nothing. I know Barb's mentioned that today. We've had a couple of webcasts that have talked about that today. Throughout the day, that's been the conversation on the Schwab network all day long. And so the likelihood is that the Fed does nothing and the market just simply goes kind of merrily along its way, kind of on this sideways path and not really getting driven one direction or the other. So how do we choose an individual strategy then? So that then becomes, and Michelle, thank you. You're absolutely right. That's coming straight from the CME Group FedWatch tool, that 96.9% probability that the Fed's going to do nothing. That's a pretty high probability, right? Now, they could, like I said, they could surprise, but who knows? So if that's the case, then if we go back to our slides really quick and we say, okay, well, what are some of our neutral strategies? Let's look at a couple of different neutral strategies here. We might look at an iron condor. We might look at, for instance, a calendar spread. We might look at a butterfly spread. We might even look at, if we had kind of a directional to neutral bias, a short vertical or either a short call vertical or short put vertical, depending on what directional expectation we might be looking for, right? So let's kind of come back over here and let's take a look at this. What I want to do, now that we kind of have that idea of neutrality, right? Potential neutral movement, that puts us in mind of some of those neutral strategies. Relatively high implied volatility without a lot of expectation of market movement, suggesting neutral strategy. Mean reversion is the key for implied volatility. Generally, implied volatility in the VIX is a mean reverting instrument, but it doesn't have a long ways to go down before it gets into kind of an area that it's been before. So there's not a lot of expectation, perhaps necessarily, that it goes down, but there is an expectation that it could go higher. So one of the things that we might do, and this is kind of where we might get to the choice perspective. I'm going to change my grid here really quickly to my single grid, and this is just kind of my sandbox. And so what I'm looking at here from this perspective, this is Apple. Apple has already passed earnings. Apple's implied volatility has gone down, but Apple from a stock perspective, is kind of at the core, if you will, of some of the issues that have created the uncertainty. I mean, certainly they have an impact from the tariff issues, but there's, the price of the stock kind of sat right here at the moment. It's kind of in that neutral perspective, right? It's kind of at a level of support. It's neither moving higher nor moving lower. We get kind of that neutral perspective, that spinning top or that doji type of candle today. Implied volatility kind of staying exactly where it is. And George asks a great question. Does the underlying implied volatility percentile for the stock itself perhaps suggest a strategy? And you're absolutely right. It may very well do that. I would argue, if I were to look at this, and we can kind of quantify this visually first, and that's kind of, you know how they say sometimes you eat first with your eyes, and then your nose, and then with your mouth. Well, when looking at implied volatility, we maybe kind of assess implied volatility first with our eyes, and then we look at the numbers, right? Because if we were to say, well, is implied volatility high or low, we could probably argue that it's not as high as it's ever been. That was certainly during the height of this downward movement, at least in this recent time frame. And it's not as low as it's been in this time frame. That was back in the depths of December, mid-December back in 24. Oh, what a night. Anyway, sorry, wrong song, wrong era. But we're getting back into this area where implied volatility is not as high as it's been. Maybe it's kind of right in the middle of that range. So neutral implied volatility. So to a certain extent, George, you're absolutely right. Implied volatility percentile or implied volatility overall is gonna suggest where that strategy might fall. There's one other way that we can look at implied volatility as a perspective, and that implied volatility percentile is one of the ways to do that. By the way, I did a webcast the other day on getting started with the Thinkorswim platform, where I talked about 10 different ways that traders can see volatility on the Thinkorswim platform. One of those is the VIX. We looked at that. One of those is implied volatility on the chart. We looked at that here. The next one might be implied volatility on the option chain. The other might be today's option statistics. So we're going to look at today's option statistics really quickly to kind of get a sense to go back to George's question. I'm glad that you asked that question. Then we're going to spend a little bit of time with that implied volatility on the option chain. So I'm going to go to the top of the option or top of the platform here. I'm going to click on the trade tab, and now we're looking at the option chain for Apple, and I'm going to scroll down, and I'm going to see this number right here, current implied volatility percentile. And you can see it right there, current implied volatility percentile. It's at the 35th percentile. And what that really means is that relative to the high that implied volatility has been and relative to the low that implied volatility has been, this is kind of down towards the bottom, towards the lower third. Doesn't mean it's high, doesn't mean it's exceptionally low. It's kind of right in that middle. So we might think about it from this perspective, and I've talked about this before, that if the range is from the 0 percentile to the 100th percentile, 35 is going to be somewhere right about there. And generally, when implied volatility is low, it rises, and when implied volatility is high, it falls. But here's the scenario. If the market falls, if the market goes down, if the stock goes down, then almost certainly implied volatility is going to rise. So we either do one of two things. We take a directional trade to take advantage of that, or we use a neutral strategy that maybe then mitigates out some of the impact of a rising implied volatility against a falling implied volatility. So let's look at how we might do this. So this is a number that we can use, right? So in general terms, to George's question, and George, I'm glad that you asked that question. You might say, hey, if implied volatility is really low, let's say, for instance, below the 30th percentile, that certainly is a strategy, a situation that benefits a strategy befitting rising implied volatility, like a long option, like a long vertical spread, like a long butterfly spread. All of those would benefit from rising implied volatility. If it were above, say, for instance, the 60th percentile, that's going to be exceptionally high. Then what we might say is that strategies that benefit from high and falling implied volatility would benefit. Short call verticals, short put verticals, iron condors, for instance, calendar spreads, where you're playing the dispersion between one expiration and another is implied volatility. So all of those would be strategies that would benefit from that falling implied volatility. But here we're in a situation where it's kind of how do we know? So we don't yet. But this is another way that we might think about this, right? We don't know what implied volatility is going to do. But I want to look at a directional strategy first, and then we'll examine the probability of a less directional, more neutral type of strategy and see which one makes more sense, because this is oftentimes the common question. Let me ask the question really quickly out there in the chat, and you guys can chat in if you want. You don't have to chat in. You can raise your hand, whatever you want to do. How many of you struggle to make a decision about a particular strategy in a circumstance like this, when the stock itself is kind of in a neutral position, when implied volatility doesn't give you really a strong signal one way or the other for rising or falling implied volatility? And you're already past an earnings announcement, so you don't necessarily have a discrete event to hang your hat on when it comes to duration of the trade. Is this a challenging time for you? It is for me. It probably is for Barb as well, in terms of making decisions about what strategy do I choose, right? So I think this is coming at a very appropriate time in this discussion. So what I wanted to do is I wanted to kind of get a sense of where there might be some price targets. Gazelle, great answer. Thank you all the time. So I wanted to get maybe some price targets here where we might see the price of the stock move. So I have one directionally. I talked about this on the network the other day. I talked about Apple moving on the network the other day, maybe up to this resistance up here around the 220 mark. What I was also looking at is maybe this move down here to the 185 or 186 level. It was previous support way back here, but it kind of seems to me that if this were to break to the downside, that's kind of a duplication of this range. So we might see it move down to this 186 mark. So what I'm going to do, I'm just going to activate that a little bit. I'm going to bring that level over just a little bit. And I'm just going to tag that with a label so that I know where that is, just so that I can see it. I'm going to call that 185. I like to put these labels on my chart so that I can see what's going on right there. It also is helpful when presenting so that you can see where that movement might be. So my thought is, at this particular point, if we're neutral, the range that this might stay in directionally between levels of support and resistance is between 220 and 185. Those are some nice wide navigational beacons. But let's take the directional side first. Let's look at the probability of success of a directional long put here in this particular case, which would presuppose the idea that implied volatility goes up if the price of the stock goes down. That's the general relationship of things, right? So let's look at a long put option. Now, here's the thing. I look at the last time that the price of the stock was down near this level, and how long did it take to get up to or make that type of move? And so I might want to say, look, when it got down here off of this support at 185, it took about 3 weeks, 1, 2, 3 weeks roughly, to get up to that level. So I'm going to kind of look at that as my expected time frame to make that move down in this particular case, taking about 3 weeks to continue to move to the downside. Now, oftentimes, though, one thing to make sure that you are aware of is that stocks, I mean, this is that old heuristic that says stocks fall out of windows and they climb upstairs, which means they go up slower than they come down. That isn't always the case, but I would argue that that's probably the case here, especially if we get a big spike in volatility, and especially if it comes from some sort of exogenous news event. It may drive this price down very quickly. So that would be okay too, but it gives us a range, right? We've got to see kind of over the horizon how far we think. So direction, volatility, duration. Those are kind of the things that we've got in the mix here in this milieu of choosing a strategy. So let's go to the option chain. We're going to go to the trade tab here really quickly for Apple, and I'm going to scroll back up in the chain. And over on the right-hand side, we're seeing implied volatility for each one of these expiration dates, right? So I'm expecting the stock's at 180, about, I'm going to call it just in round numbers. Go back to the chart. I'm going to call it in round numbers about 200. right? And I'm expecting it to come down to about 185. That's that next target. That's about 15 points to the downside. So what I'm going to do is I'm going to look at that trade tab, and I'm going to look at where implied volatility suggests based on this expected value move or expected move formula, which is just simply looking at what's the one standard deviation move in that particular time frame, and see where I get to just about that 15-point move to the downside. And lo and behold, would you know it? About 3 weeks, maybe a little bit longer than 3 weeks, out to the 30th of May, gets me to about that 15-point expected move to the downside. Interesting. Okay. So if that's my expected move within that duration, now I've got my duration set, right? So watch what I'm going to do. I'm going to come back over here and I'm going to say, all right, we're going to open up this option chain. And my expectation is a move from where it is now down to that 185. Now, I'm not going to choose the 185 strike necessarily, because the 185 strike doesn't start to gain intrinsic value until the price of the stock gets to that 185 mark, right? I'll tell you what, Brent Moore's taught a great webcast just a couple of hours ago on directional long options and talked a lot about that idea in terms of choosing a strike price. So what we're going to do is we're going to just simply, at the first part of this discussion, we're going to use this 185 strike, which is our price target, as a measure of probability. The probability that the price of the stock is going to get there. We're not going to choose that strike necessarily if we were going to actually select this as a long put option strategy. But we're going to do one thing here. I've got delta as a column in this layout, first of all. What I'm going to do, I also have theta and vega, and theta and vega are important. That absolutely is important in this discussion. But I'm going to change my layout a little bit. I'm going to go delta, but I'm going to add something to delta. So I'm going to go to customize my column. I'm going to take theta and vega out of this mix, and I'm going to say probability of in the money. So I'm going to go P-R-O-B, probability of in the money. I can even do this, probability of touching, but I'm going to go probability of being in the money because I want to see maybe a little bit of a move beyond that. So I'm going to go probability of being in the money at expiration, and I'm going to click on OK. And there we go. I've got delta and probability of being in the money. Those two are pretty darn close to one another. That's why we say we could use delta as kind of a thumbnail for that probability of being in the money at expiration. About a 23% probability of being in the money at expiration, which corroborates the idea that this is about the one standard deviation move, right? If one standard deviation incorporates about 68 point whatever percent of price returns, well, then the other side of that's going to be about 31.2 some odd. So we're a little bit outside that expected, that one standard deviation move. That's okay. But that tells me that that's kind of the objective probability of success of this trade, or at least the success of this stock getting down to that 185 mark. So if that's the case, this is a low probability trade, isn't it? We can see that. That becomes a low probability trade. The probability of it getting out to 185 becomes a low probability perspective. So there's another thing that we might think about. So if we're going to buy an option, right? Maybe we want to take the other side of that equation. We want to take the other side of that probability equation if we're going to go long the option. So that maybe puts me kind of in the reverse of this 23% probability. Maybe we go down here to the 205 strike, which has about a 70% probability of being in the money at expiration, which now flip-flops that equation and says, look, that's got about a 70% of probability of being in the money and having some intrinsic value. But what's the probability of getting to success in this particular trade? Well, first of all, we're buying an option that has already intrinsic value. So if it just stays where it is, aside from the decay of time, we're going to have some intrinsic value left. But what's the probability of us seeing maybe even at least break even at this particular point? So you know what I'm going to do is I'm just going to see what my break even point would be. Now I can calculate that. I could say it's 205 plus the cost of the trade. So here's where I've got to get to in order to get to break even. So I'm going to click on that trade. I'm going to click on the ask price. I'm going to just kind of walk through this here really quickly. And I'm going to click on confirm and send. And I'm going to say, look, 194.90 is my break even price. Stock's got to get to 194.90 for me to break even on the intrinsic value alone, because that's at expiration. Okay. Well, what's the likelihood that the stock moves to 194? We'll just call it, we'll round that up and we'll say 195, because that's more than a one standard deviation move. That's more than a one standard deviation move. This becomes even more of a low probability trade, because if we come back here and we say, oh, well, holy cow, what's the probability of the stock getting to 195, right? It's got to go down to 195. Well, that's about a 40% probability. So that's inside that one standard deviation move, excuse me. What's the probability of this option getting to 195? Well, about a 40% probability of getting to 195. So that's just getting to break even. So this is a relatively probable, but not more so than a coin toss probability of getting to 195, getting to break even. So maybe we don't choose this strategy because that would require the stock to at least move a little bit to get us to that break-even point so that we could overcome the cost of placing the trade to begin with. That already puts us kind of behind the curve a little bit when it comes to maybe finding success in this trade, right? If success is just getting to break even. Now, there's another way that we could look at this in terms of the probability of touching that level. And one of the ways that we can do that, we know that we're out here at about 24 days to go until expiration. We could go to the Analyze tab. So what I'm going to do is I'm going to go back to our order here really quick. I'm going to pop that up and I'm going to right click and I'm going to send this to the Analyze tab. Now, I was doing this earlier, so I'm going to take that one out of the equation. And I'm going to say, look, what's the probability that the price of the stock gets to somewhere in that range, right? To that 198 range or so, or that 195 range in, well, 30th of May, right? That's about 36% probability. This is just simply the probability analysis range. And this is that probability of expiring cone that we can put on the chart. It's just looking at it in this horizontal view. So you know what I can do is I can come down here and I can say, where's 195? There's 195, and I can put a slice there. And there's my slice at 195. So now what I could do is I can say, all right, we're going to go out, what are we, 25 days here to go until expiration, the 30th of May. And that means if I kind of squish this out so that you can see it a little bit better, let's kind of squish this out. Here's 30 days to go, 25 days to go until expiration. That's right here. That's that 30 May. Where do those two cross? Well, there's our kind of coin flip, almost. 56% probability that it doesn't get there, 44% probability that it does get just to break even. But what about our target? Where's our target here? And we could come down here to 185, which is where we're targeting, is that level of support. We could put another hash mark right there, and we could say, all right, here we are, 25 days to go until expiration. That's where we've got about that 75% probability of not getting to our target, about a 24% probability of getting to the target. So that gives you some sense of the probability of success in this particular strategy. So let's flip the script here. Let's look at a strategy that maybe takes advantage of that fact and gives us the opportunity perhaps to, well, at least maybe mitigate out some of that impact of implied volatility rising. So what we could do is we could choose a long put vertical spread, which would benefit from the rise in implied volatility, but it still has a directional aspect to it, right? So let's go back to our trade tab and we could say, look, instead of just buying that long put, let's do something else that maybe increases our probability of success in the trade. And if our probability of success in this particular case of getting to that target is about 25%, right? If that's our probability of success in getting to the target, not just to break even, to the target, well, could we do better than that by creating a long put vertical spread instead of just a straight up long put, right? Still has directional expectation, but we're going to do a little bit better than that. So, you know what we might do is we might still buy that 205, right? Buy the 205 and sell the 195. Now we've got a long put vertical that has lower cost than the trade that we bought to begin with. And by the way, it has a lower break-even price. I mean, simply because of the way the trade is put together. But we don't make as much in the trade. This is a 10-point wide vertical spread. We're going to make about $6 in the trade, $5.50 in the trade. So if it goes to success, which will be in the money at expiration, so all it's got to do is get to that 195 level, which we said was about a 44% probability of getting to that level. But you know what we can do? Here's what we can do is we can come up with the net delta of this trade and see if that changes our probability. So I'm going to come back to our calculator and I'm going to say, look, here's a 64-cent delta, all right? We're long 64 deltas and we are short 40 deltas. That puts us right about at the same probability of success as our long directional put. Now I'm confused. Which one do I choose? If they're the same probability of success, why would I choose the long vertical instead of the long put itself? Let's go back and let's look at that long put. We were looking at buying the long 205, right? We're going to the long 205. That long 205 is going to cost us in this trade $1,010 for the long put, and is more directionally, well, about the same directional sensitivity, but it's more theta sensitive, right? We come back over here and we say, look, that's more theta sensitive. If we were to put, I'm going to put theta back on this link. So we're going to look at delta theta vega. That long option is more theta sensitive. So it's going to suffer from the passage of time. So if this doesn't make that move quickly, that's going to hurt us. And direct and vega sensitive, vega sensitivity is a little bit higher. But if we were to put our vertical spread in here, what's our vertical spread's vega or theta sensitivity first of all? So we've got 11 cents of long theta minus the one we're selling, which is 13 cents of short vega, or excuse me, short theta. Using the long vertical spread would actually put theta in our favor in this particular case. That's working in our favor. So the passage of time, the inevitable, is working in our favor. That might be the deciding factor in and of itself. Now let's look at vega. We're long 19 cents of vega, and we're short 20 cents of vega. Well, basically that's a push, right, when it comes to volatility sensitivity. So here's the trade-off now. Here's what we're left with our characterization, with our two choices here. The long put spread versus the long put itself. The long put, same directional sensitivity as our long put vertical that we've created here, but suffers more from the passage of time. Gains more if implied volatility goes up. Implied volatility going up isn't guaranteed, but the passage of time is. So that might be the negative for the long put option. Our long put vertical spread, the 205, 195 long put vertical, benefits from the passage of time, which is the inevitable, and is essentially not sensitive to changes in implied volatility, which isn't the inevitable, but is the likely result. So if there's one deciding factor out of all of those two, it is simply this, that in order to get to success, the long vertical spread has to go less distance, meaning we need less directional movement, and the passage of time is working for us, which is the inevitable, and we don't care about implied volatility, whereas the long put option requires a bigger move. In fact, to get to success, to get to that probability, it's got to go out to 185, and it suffers from the passage of time. So if it doesn't move quickly, that's going to hurt us. But if implied volatility works and goes up, that might benefit us. So inevitable versus the likely, I'm going to take the inevitable in this particular case, even though our potential gain is a little bit lower in the long vertical spread. And so that's how we get to that assessment of a particular strategy, one versus another, right? So how do you decide how much of a spread you should be considering? I'll tell you what, strike price was one way to do it, percentage difference, absolute dollar amount. All of those are ways to look at it. I'm going to tell you where you can go to find more information about which strategy you might use in terms of position size. Barb Armstrong teaches a phenomenal webcast. And in fact, I think she does it 2 days a week on trading a smaller account, where that is one of the primary factors of making a decision, is how much that trade costs, what the risk is in the trade. But if you want more information about these particular types of strategies and that particular idea of choosing a strategy, come on over here to the Schwab.com website and go to coaching, or come over here to our Trader Talks webcast page. And I'll just put in that link right here. You can type in any subject you want, but trading a smaller account is one way you can search for this. And there's Barb Armstrong's full playlist right there, trading a smaller account. Great way to look at these strategies. And I hope that this has been helpful in making a decision about choosing one strategy versus another. Hey, you can follow us on X at Ben Watson CS, at Barb Armstrong CS. Love to have you over there. If you come over here to the webcast, and by the way, if you can do this right now too, click on the bottom of the page there where it says subscribe. If you come here to the Trader Talks webcast page and you haven't already subscribed, click on that subscribe button. That's all we ask of you. Guys, have a great day. I'm going to be back later this afternoon talking about iron condors in our Advanced Options Strategies virtual workshop. I hope you'll join me there if you are already enrolled. If you aren't, check it out on the Schwab Coaching page, and you can get registered for that event if you want. Thanks to Barb Armstrong for helping out. Thanks to Bree and all of our great production staff for helping to bring this to you. Hopefully this has been something that has been helpful for you. We will see you soon. Take care, everybody. Bye-bye.